Hello friends, welcome to the channel JIB and CIB Made Simple. So this is our BFM unit number 13 theory portion. The topic is risk regulation in banking industry. Have you ever wondered why banking industry are so tightly regulated? Is it just about rules and policy, or is there something deeper at play? Let's break it down into simple terms and uncover why regulation is crucial for the banking world. Stay with me till the end, and I promise this will not only make you exam ready but also crystal clear on the concept. So let's start with alright, so let's start with the basics. Every country has monetary authority like the Reserve Bank of India here, which is the boss when it comes to managing bank and financial services, right? Monetary authority of each country, right? So banking and financial services. Why? Because bank and financial services are the backbone of our economy, right? You can see banking and financial services are the backbone of our economy. If they fail, the entire system can crumble like a house of cards. So you can see the importance of banking and financial service. Think about this. Bank handle not their own money but our money, deposits from the public. That makes them a highly leveraged business. You can see this word written here, highly leveraged business, right? Meaning they operate on borrowed fund. Bank operate on borrowed fund. If something goes wrong, who suffer first? The depositor? That's us, right? Now banking is not a risk-free game. You can see it written here. Banking is not a risk-free game. Bank take calculated risk every day, be it in lending, investment or operation. While taking risk is a part of their job, these risks need to be managed well, right? This is where the monetary authority steps in. This is where the monetary authority steps in. They ensure that bank take a smart risk and avoid reckless one, right? So risk, obviously risk is a part and parcel of the business, but a smart risk should be taken, right? Not reckless one, right? So what is the ultimate goal? What is the ultimate goal? The ultimate goal is to protect the depositor like us, like you and me, and to prevent disaster like bank collapse that can shake the economy. A strong and healthy bank system is the foundation for prosperous economy. Simple, right? So you can see monetary authority regulate the bank, right? So making a highly leveraged business, already we have discussed. Proper regulation is crucial. So hopefully now it is clear. So next time when you hear about banking regulation, remember they are not just rule, they are the lifeline for our economy and our hard earned money, right? Now let's move on to the next slide. So now in this particular slide, we will dive into a critical topic, the goals and impact of banking regulation in India. Have you ever wondered how these regulations actually work behind the scene to keep our banking system safe? Stick around and I will simplify it for you in just a few minutes. Let's start with the star of the show in the Indian banking world, and that is none but Reserve Bank of India. It's our country monetary authority, the ultimate regulator that ensures bank operate safely and efficiently. Now, why are the regulations so important? Think of them as a safety net in high wire act. You can think of them like a safety net, right? Bank deal with risk every day, and regulations set the boundary and guidelines to manage these risks effectively. You can see regulations set the boundaries by setting constraint, by setting the guidelines, right, to manage these risks effectively. Let me give you an example to substantiate it. See, for example, they help bank understand and measure risk more clearly. But regulation don't stop there. They have specific goals that directly impact how the banking industry operate. So let me talk about the goals of the regulation. Just now I have told you that regulation have specific goals, right? Regulation have specific goals that directly impact how the banking industry operate. So what are the 5 big goals of banking regulation? The first goal is improving safety, right? So regulation impose capital requirement that are aligned with the risk bank take. So this ensure bank always have financial cushion to absorb the shock. So this is the improving safety, that is imposing capital requirement. So regulation impose capital requirement that are aligned with the risk bank take. This ensures bank always have financial cushion to absorb shock. The second thing is fair competition. Leveling the competition means, in simple word I can say, fair competition means by setting common benchmark, regulation create a level playing field for all the banks, whether big or small. The third goal of regulation is promoting sound practices. What does it mean? Regulation encourage good business and supervisory habit so bank operate responsibly. The fourth goal is controlling systemic risk. See, the regulation monitor and manage risk that could impact the entire banking system, kind of like stopping one bad apple from spoiling the whole bunch. Right, so a bad apple can spoil the whole bunch. So similarly, when we control systemic risk, it means we are managing risk that could impact the entire banking system. And the fifth goal is protecting depositor interest. Since depositor can't directly control or discipline bank, regulation steps in to safeguard their interest. After all, it is our hard earned money at stake. So the next time you think of banking regulation, remember, they are not just red tape. They are the backbone of a safe and thriving financial system. So if you think that this explanation is useful to you, you are able to understand, please hit the like button. This will encourage us to make more such content. Now let's move on to the next slide. Imagine this, one bank fails and suddenly the entire banking system starts shaking. Sound scary, right? I will explain what it is, why is it so dangerous, and how it keeps regulator on their toes. Stay with me till this particular slide and you will have a crystal clear understanding of this important topic. Let's break it down. This is called systemic risk. Systemic risk means the risk of failure of the entire banking system, not just one bank. Now you might wonder, how can the collapse of one bank threaten the whole system? Here is how. Banks are deeply connected with each other. You can see banks are deeply high interrelation. That means banks are deeply connected with each other through mutual lending, borrowing and various financial commitment. Think of it like a dominoes arranged in line. If one fail, it can cause a chain reaction. Here is an example. So let me give you an example to make it more clear. If a bank fails and can't pay back what it owes to another bank, the other bank suddenly faces a cash crunch. This is because the money it was expecting, which we call receivables. You know this meaning of this receivable. So money that bank was expecting is now not available. It is unavailable. So this shortage can spread to other bank that has ongoing commitment with the affected bank. So let me see. Suppose this bank A. Okay, this bank A fails. It can't pay back what it owes to the bank B. So this bank B will face a cash crunch because the money it was expecting from bank A, which we call receivable, is now not available, and this shortage can spread to, suppose B has taken loan from C. So this shortage can spread to other bank that has ongoing commitment with the affected bank. So this chain reaction is called what? Contagion effect. This is called contagion effect. One failure leads to another, and before you know it, the entire system is at risk. That is why systemic risk is such a big headache for regulators. They work tirelessly to identify and control these risks to prevent a total financial disaster. So systemic risk is not just a banking issue, it is an economic issue that can affect everyone, from big corporation to everyday depositor like you and me. So understanding systemic risk is vital for your CAIIB BFM examination and for grasping how the banking world operates. If these things make you simpler, now let's move on to the next slide. So the next topic that we have, see, have you ever wondered how banking regulation have evolved over the years? So already we have know banking regulation is all about, right? What is important? What are the goals? We have already known it. Now, have you ever wondered how banking regulation have evolved over the year and why risk-based regulation is the need of the hour? Let's dive into this fascinating journey from the stable banking world of 1970 to the fast-paced, riskier environment we live in today. Stick around and you will get valuable insight that will make your preparation a breeze. Let's travel back to 1970. Banking was all about stability back then, thanks to strict regulation. You can see it was all about stability. There was not much competition, and the primary focus was on safety and managing money efficiently. What was the primary focus? Safety and monetary management. Sound like a calm environment, right? But then come deregulation. This encouraged faster growth, globalization and increased competition, right? Faster growth, globalization, increased competition. While this was a great for innovation, it also brought in higher risk. Banks started facing new challenges and the old regulatory framework just were not enough, right? So this was great for innovation, right? Deregulation was great for innovation, but it also brought in higher risk. Banks started facing new challenges, and old regulatory framework were just not enough. Even the BCBS, you know what is BCBS? Basel Committee on Banking Supervision. So now enter the BCBS, formed in 1974. It was formed in 1974. This committee was tasked with creating a global regulatory framework to manage risk and promote fair competition among banks. It is headquartered at BIS. Remember this is super important. BIS means Bank for International Settlement, which is located in Basel, Switzerland. Okay, it is based in Basel, Switzerland. Now what is BIS? It is like a central bank of central bank, founded in 1930 and owned by central bank worldwide. Its mission is to foster international monetary and fiscal stability. It is based in Basel but also had representative in Hong Kong and Mexico City. The BIS board is responsible for setting the strategic decision and policy. Right. So what it does? It set the, you can see, it determines the strategic and policy direction. Okay, they meet at least 6 times a year. At least 6 times a year the BIS will meet, committee will meet, working closely with 4 advisory committee to ensure everything runs smoothly. And here is an interesting fact. The Basel committee itself was formed by the central bank governor of group of 10 country. Remember this super important fact. Central bank governor of the group of 10 country, they formed the Basel committee. Their goal was what? What was their goal? To make sure banks worldwide follow a consistent and risk-based regulatory framework to keep the global financial system safe and sound. Understanding this regulatory body and their evolution is crucial for cracking your CAIIB BFM examination. Friends, if this explanation made things clear for you, show me some love by hitting that like button and subscribing to the channel. And if you are serious about acing your exam, don't forget to check our complete JIB and complete CIB preparation package, PDF, MCQ, quizzes, videos. So you can call me on this particular number or WhatsApp me on this number to get started today. Now let's move on to the next topic that we have. Why BCBS? Do you know that single bank failure in 1974 led to the creation of the global banking regulator BCBS? Intrigued? Stick with me and I will simplify everything you will need to know about the Basel Committee on Banking Supervision, that is called BCBS, and why it plays such a crucial role in today's financial world. Let's start with an incident from June 26, 1974 that shook the entire banking world. The name was Hofstadt risk. Here is what happened. Bank in Frankfurt. Bank in Frankfurt released Deutschmark to a bank called Bank Hofstadt in exchange for dollar payment that were supposed to happen later in the New York. Let me again repeat. Bank in Frankfurt released Deutschmark to a bank called Bank Hofstadt in exchange for dollar payment that was supposed to happen later in New York. But before the dollar payment could be made, German regulator liquidated the Bank Hofstadt. You can see German regulator liquidated the Bank Hofstadt. This created a settlement risk, now famously known as Hofstadt risk. This event was a wake-up call for the banking world. To prevent such risk, the G10 country came together in late 1974. The G10 country, you know, G10 group. So the G10 country came together to form Basel Committee on Banking Supervision, that is called BCBS. The BCBS was established under the Bank for International Settlement, that is called BIS, Bank for International Settlement, to create global standards for banking stability and risk management. Now the G10 country has grown into G20. It has expanded to the G20. The G20, which includes countries like India, US, China and many other. These nations don't just focus on banking, they coordinate on global issues like trade, right? They coordinate on global issues. You can see written here, trade, health, climate and other issues. It was founded in 1999. Earlier it was G10, now it has started to G20. You can see the country name here, Argentina, Australia. These are the name of 20 countries which are involved in this particular group. Now here is an interesting fact. The G20 accepted the Basel III norms during their 5th summit in Seoul in November 2021. These norms are crucial for maintaining global banking stability. The G20 continues to meet regularly to discuss key topics under themes like people, planet and prosperity. Over the time, the Basel Committee has expanded its membership. From initial G10, it includes 45 institutions from 28 jurisdictions. You can see it includes 45 institutions from 28 jurisdictions. This expansion highlights its growing influence in ensuring that banks worldwide operate safely and responsibly. Understanding why BCBS exists is essential for your CIB exam and for appreciating how the global financial system works. So hopefully you have understood that the history of this particular BCBS, why it was necessary, the Husted Bank incident, it triggered the need for this particular BCBS. Now, have you ever wondered how global banking regulation stay consistent across country? That's the magic of the Basel Committee on Banking Supervision, that is called BCBS. Today in this particular slide we will break down the international standard, key group, and why they are crucial for banking stability. Let's start with the big picture, the international standard set by the BCBS. So let's start with this international standard. You have probably heard of Basel I, Basel II, Basel III. These are global framework that guides how banks manage risk, capital, and overall stability. But why are these standards important? Well, banks operate across border. Imagine if country had its own completely different rule, that will be chaotic. Wouldn't it be chaotic? Suppose the country has its own complete different rule, it will be chaos, right? The BCBS stepped into to standardize regulation so banks worldwide follow a consistent approach, especially when working across jurisdiction. To ensure this, the Basel Committee meets 3 to 4 times a year. Right, you can see meets 3 to 4 times a year, and it does not work alone. It has a specialized group that handles different aspects of banking regulation. Here it's a quick breakdown. Okay, so the first is policy development group. As the name suggests, this group develop new regulation and update existing one. The next is supervision and implementation group. So question can be asked, which one of the following is not a Basel Committee group? So you should know the name of the group. Supervision and implementation group. It ensures that standards are applied correctly across country. Then we have Basel consultative group. This group focuses on bringing in perspective from non-member country to make regulation more inclusive. Then we have macroprudential supervision group. They keep an eye on the systemic risk that can affect the entire financial system. Then we have accounting expert group. This team ensures that financial reporting and accounting practice align with the global standard. So these groups report directly to whom? These groups report directly to the BCBS chairman. They also have a smaller task force that handle specific technical issues or short-term tasks. You can see this group report directly to the BCBS chairman, and they also have it also includes a smaller task force that handle specific technical issues or short-term tasks, limited time tasks. So this structure ensures that every detail of global banking is managed efficiently. So the next time you hear about Basel standard, you will know the hard work that goes into making our financial system stable and secure. Now let's talk about the international cooperation. Have you ever wondered how international banks are supervised across border? With branches, subsidiaries, and joint ventures scattered globally, how do regulators ensure consistent oversight? That's where international cooperation comes into play. In this particular slide, we are decoding how the Basel Committee ensures no bank slips through the crack. To make global banking safe and transparent, the Basel Committee has taken major steps to ensure consistent supervision across jurisdictions. Here is how they have done it. The Concordat of 1975. This was the starting point. It set basic principle for diving supervisory responsibility. Sorry, let me again rephrase. This was the starting point. It set the basic principle. You can see it set the basic principle for dividing supervisory responsibility between the host country. You can see this word host country. When I say host country, it means what? Where the bank operate. Okay, that country in which the bank operates, that is called host country, and the parent country. What is the meaning of parent country? Where the bank is headquartered, where the SQ is located. Let me again rephrase it. The Concordat of 1975 was the starting point. It set basic principle for dividing supervisory responsibility between the host country and the parent country. It ensured that foreign branches and subsidiaries were not left unsupervised. So this Concordat clearly laid down principle that suppose SBI has a SBI parent country is India and SBI host country is USA. Suppose. So this Concordat of 1975 it laid down the principle for dividing the supervisory responsibility between these two countries. Right. So this is all about Concordat of 1975. Now there then we have 1983 update. Let's move on to the next slide. Then you can see we have okay, so we here, okay, it was revised. Just wait a minute, I think it is repeated. Okay, fine. It was revised in 1983. You can see written here, it was revised in 1983. The Concordat evolved into principle for supervision of banking foreign establishment. So you can see this word, I have highlighted it. Okay, so one characteristics and one feature of this PDF is that all the important points have been highlighted so that it does not get slips out right. So principle for the supervision of bank foreign establishment, right? So it was revised in 1983 as this. This revised version clarified roles and responsibilities for even better coordination. Then we have 1990 supplement. What does it mean? This focused on improving the flow of crucial information between supervisor in different country. Okay, so crucial information flow is improved. After all, timely sharing of data is key to identifying risk early. Then we have 1992 minimum standard. So this reformulated the supervision principle, focusing on international banking group and their cross-border setup. The goal, what was the goal? To make sure even complex banking structure are properly regulated. Let me again rephrase what was the 1992 minimum standard. That the supervision principle, focusing on international banking group and their cross-border setup. The goal was to make sure even complex banking structure are properly regulated. Then we have 1996 report. So, with bank becoming increasingly global, this report addressed challenges in supervising international bank. Endorsed by supervisor from 140 country, it laid the groundwork for effective consolidated supervision of cross-border operation. Again repeating, with bank becoming increasingly global, this report addressed challenges in supervising international bank. It was endorsed by supervisor from 140 country. It laid the groundwork for effective consolidated supervision. So these milestones reflect the Basel Committee relentless effort to close gap in international supervision. Their aim to make sure no banking establishment escape scrutiny and that supervision remain consistent worldwide. You can see our first the Concordat 1975. Then we have 1983. It was revised. Then 1990 supplement, cross-border flow of prudential information. Then we have 1992 minimum standard, 1996 report. Right. So now you know how the Basel Committee keep the global banking system in check. Now let's see the next slide that we have. FSB 5 principle. So during the pandemic, did you ever wondered how the global financial system managed to stay afloat? Well, it was not just magic, it was a strategy. Today we are diving into Financial Stability Board, that is, in short it is called FSB. 5 powerful principles that keep the financial system strong during COVID-19. Right. So trust me, this is crucial for your CAIIB BFM examination. The FSB introduced these principles to tackle the challenge posed by the pandemic, ensuring the financial system could keep running smoothly. Let's break down. The first is lending and credit support. You can see written here, lending and credit support. Think of this as making sure bank could keep giving loan even during tough time. How? By using tools like loan guarantee schemes, by restructuring loan terms, by releasing a special capital buffer that is called counter-cyclic capital buffer. These ensured business and individual could access money they needed. So that is called lending and credit support. This is the first principle. Okay. Then we have funding and liquidity support. Imagine a situation where bank need money themselves. This principle ensured they had enough fund by providing easy access to domestic and foreign currency. Launching funding facility. You can see easy access to domestic currency, foreign currency, launching funding facility, and even purchasing asset to inject cash into them. Right. So this is how funding and liquidity support are provided. Then we have market functioning. Financial market were under stress during the pandemic with wild fluctuation. The FSB, that is Financial Stability Board, it focused on keeping market stable by enhancing surveillance and introducing mechanism to control volatility. You can see written here, enhancing market surveillance and volatility control mechanism. The FSB focused on keeping the market stable. In simple terms, they prevented chaos in the trading activity. That is called market functioning. So we have seen 3 action: the lending and credit support, funding and liquidity support, market functioning. Then we have operational and business continuity of financial institution. Bank and other financial institutions needed to stay operational despite lockdown and other disruptions. This principle ensured they had strong measures to keep their business running, from enabling remote work to safeguarding customer services. And finally, we have authority business continuity measures. Lastly, the regulators themselves needed to control their activity, whether it was supervising bank or implementing new policies. This ensured no gap in oversight, keeping the system in check. So these 5 principles show how FSB acted like a safety net for the global financial system during the pandemic. And for your BFM examination, these golden points are super important. These are the golden point which you need to remember. So already we have seen this FSB 5 principle. I think it is repeated. So did you know that the banking world changed forever in 1988? What I am saying, that banking world changed forever in 1988. That is when the first Basel Accord was introduced. Remember, this question was asked in the recent examination. Basel first when it was introduced? 1988. Setting the stage for how banks manage risk and capital today. If you are preparing for BFM, understanding Basel I is non-negotiable. So let's make it easy for you. Basel I, also known as Basel Capital Accord, it was a game changer. Here is the backstory and key highlight simplified. First question is why Basel I? Right, why Basel I? Let me simplify it. See, after the banking industry faced increased competition and risk due to deregulation, the Latin American debt crisis exposed the urgent need for a stronger risk control. So here it is a Latin American debt crisis. Okay. Because of deregulation, competition increases, right? Risk increases. Latin American debt crisis exposed the urgent need for stronger risk control. Basel I was born to address this challenge by linking a bank risk to the capital. So what did the Basel I do? The first thing is capital requirement. Banks were required to maintain a minimum capital to risk weight ratio of 8%. That is called minimum ratio of capital to risk weight ratio of 8% by 1992. By 1992, the bank has to maintain this capital to RWA ratio of 8%. Now, then the concept emerged that is called risk bucket. Let's see in the next slide. You can see risk bucket. So, bank assets were divided into 5 categories based on credit risk with weight of 0%, 10%, 20%, 50% and 100%. For example, government security were in 0% bucket, meaning they were considered risk free. Then we have off balance sheet exposure. For the first time, off balance sheet item like guarantee and letter of credit were included in the risk calculation using a specific credit conversion factor. That is called CCF. For the first time, okay, the off balance sheet exposure, guarantee, letter of credit were included in the risk calculation using CCF. That is called specific credit conversion factor. Then we have capital definition. So it introduced tier 1. Tier 1 is known as core capital like equity, and tier 2, that is called supplementary capital like subordinate debt. So it was introduced by the Basel I. So why it was important? Why was it so important? So Basel I marked the first global effort to set international standard for capital adequacy, ensuring bank has enough resources to absorb risk. Although it was criticized for being overly simple, it laid the groundwork for advanced risk management framework like Basel II and III. So it was criticized. Now the question is, who adopted it? Who adopted this Basel I? All the 12 members of the Basel Committee signed on, making it a key milestone in the international banking regulation. This also forced banks to improve how they measure, understand and manage their risk. So the Basel I was the starting point of the modern banking risk management. It is an essential topic for your BFM examination. It started in 1988. Okay, and a minimum capital to RWA has to be attained by 1992. Now let's talk about this important ratio called Cooke's ratio. Ever wondered how banks measure their ability to handle risk? Let me introduce you to the Cooke ratio, a key concept in banking regulation. So stick with me to this particular slide. I will break it down for your BFM examination in a way that is easy to understand. Let's start with the Cooke ratio, which is a part of Basel I. This ratio is all about what? This ratio is all about this key term that is called capital adequacy. This ratio is all about capital adequacy. A fancy term that means how much money a bank has to protect itself against risk. So how much money a bank has to protect itself against risk. Right, that is called capital adequacy. How much money a bank has to protect itself against risk. Basel I set a minimum of 8% for CRAR. Okay, minimum 8% was set for CRAR. What is the CRAR? Capital to risk weight asset ratio, which tells us how much capital a bank should hold based on its risk exposure. So this CRAR tells us, what does it tell? It tells us how much capital a bank should hold based on its risk exposure. In India, bank need to maintain 9% CRAR, minimum 9% CRAR, which means for every 100 rupees of risky asset, the bank need at least 9 rupees in capital. That means how much money a bank has to protect itself against risk. So Basel I has set a minimum of 8% for CRAR, which tells us how much capital a bank should hold based on its risk exposure. In India, bank needs to maintain 9% CRAR, which means for every 100 rupees of risky asset, the bank needs at least 9 rupees in capital. So when I say 9% CRAR, it means for every 100 rupees of risky asset, bank need at least rupees 9 in capital. This ensures that if something goes wrong, like a loan default or a bad investment, the bank can absorb the loss. So if something goes wrong, like a loan default or bank investment, the bank can absorb the loss. Now the question is how the quick ratio is calculated. So the ratio includes both the on balance sheet item. When I say on balance sheet item, it means loan, and it also includes the off balance sheet item like guarantee and letter of credit. This gives a full picture of the bank credit exposure. Simply put, it measures how much capital that bank has for every unit of the risk it is taking on. More capital means more ability to handle the risk. Like I have given you example, for every 100 rupees of risky asset, the bank need at least rupees 9 in capital. So it's quite simple. Higher the quick ratio, it indicates that more ability to handle the risk, because it includes both the on balance sheet item as well as off balance sheet item, right? Now let's talk about the 1996 amendment. So I think it is clear now, Cooke's ratio. Now 1996 amendment to include market risk. In 1996, things got even more detailed with an important amendment to the Basel I. What was it? The Basel Committee on Banking Supervision (BCBS) realized that banks also face market risk, like the risk of losing money due to the changes in market price. So when I say market risk, it means market prices change, right? And since market price is changing, so bank is exposed to risk, especially from trading activity. So in 1996, bank decided to add a capital cushion for these risk. Bank decided to add a capital cushion for these risks. The amendment came into effect in 1998, right? So this amendment took effect in 1998. Banks were now required to hold additional capital to cover the potential loss from market movement like fluctuation in stock price or currency value, right? In 1996, bank decided to add a capital cushion for these type of market risk, and this amendment came into effect in 1998. Banks were now required to hold additional capital to cover the potential loss from market movement like fluctuation in stock price. This was an important step because it recognized that trading activity posed a serious risk to the bank financial health. So by now you should have a solid understanding of the Cooke ratio and how it helps banks stay safe by linking their capital to the risk they take. Plus the 1996 amendment made sure bank has enough cushion to handle market shock. Now let's ready to dive into the important milestone in the banking regulation. Let's talk about the 1996 amendment, right? So we have already discussed, I think 1996 amendment, have we covered it? Let me see. Yeah, here it is, 1996 amendment, just we are covering it. So market risk was included. So what was the key feature of the amendment 1996 1998? Let us clear. Let's break down the key point of the amendment. The first is called proprietary model. What is the meaning of this? Try to understand. Banks were now allowed to use their own model to measure market risk. So that is called proprietary in-house model. That is called own model, right? Think of it like bank creating their own risk management measurement tool, which is more customized to their need. But there is a catch. They had to follow a strict rule. The second thing is value at risk concept. That is called VAR, right? So bank must calculate VAR every day. What does this mean? It is basically a prediction of how much a bank could lose on its trading activity in a day with 99% confidence. Let me again rephrase it. How much a bank could lose on its trading activity with 99% confidence. This means the model is designed to make sure that in the most cases the bank will not lose more than the predicted amount, right? So this model, that is called VAR model, it is designed to make sure that in maximum cases bank will not lose more than the predicted amount. So suppose I have predicted this maximum amount, this is suppose 1 lakh I have predicted, so bank should not lose more than this amount, right? So VAR is a prediction of how much a bank would lose on a trading activity in a day with 99% confidence. So this is the maximum amount that a bank could lose on its trading activity in 99% confidence. Means only 1% chance is that the bank could lose more than that amount. Suppose I have predicted 1 lakh amount, so only 1% chance is that bank could lose more than 1 lakh amount, right? That is all about VAR. So now let's talk about the next key feature of this amendment, that is day and okay, we have covered it, proprietary in-house model. Okay, and now the next point is daily and historical measures. Bank use 10-day trading, okay, you can see it here, in imposing a capital which is higher of the previous 3 times. Okay, where it is, just wait a minute. Okay, so the next point is bank use a 10-day trading horizon and 1 year historical observation period to calculate VAR, right? So it means that clear longer term picture of the risk. Then we have capital charge. To ensure that bank is protected against these risks, it must hold a capital charge. I think I have left something in the previous sphere. Yeah. So here it is. You can see 10-day horizon. Let's make it clear. So it means that bank use a 10-day trading horizon and 1 year historical observation period, okay, to calculate VAR. This gives a clear long-term picture of the risk rather than just focusing on 1 day. Now, next is capital charge. To ensure bank is protected against this risk, it must hold a capital charge. The charge is higher of the previous day VAR or 3 times the average VAR of the past 60 business day. Higher of either the previous day VAR you take or 3 times the average of the daily VAR of the preceding 60 business day. So last 60 business day, you take the VAR, find it average and take the 3 times. Either take that or take previous day VAR, whichever is higher, right? So capital charge based on them. Then we have something called back testing. What is this back testing? See, the bank has to back test its model, which means checking if the prediction were accurate over the time. That is called back testing. To check whether the prediction were accurate over the time. If the model does not perform well, it is just a plus factor, adding more requirement to the risk calculation. So this is called back testing. Back test its model, right? Utilizing back testing to validate model. It means checking if the prediction were accurate over the time. And if the model does not perform well, it get a plus factor, adding more requirement to the risk calculation. Then we have, so also we are talking about the market risk basically. Back testing is used to validate the model and determining the plus factor. And then we have something called short term subordinate debt. Bank could use tier 3 capital, which comes from issuing short term subordinate debt to meet part of their market risk capital. So tier 3 capital can be used to meet part of their market risk capital. This is like borrowing money to cover risk, but it has to be used carefully. Now let's talk about something called a standardized approach. See, for bank that did not use proprietary model, there was an alternate standardized approach, right? This method calculates general market risk. You can see it calculates the general market risk and specify specific security risk separately and add them together to determine the capital requirement. So that is called a standardized approach to calculate the market risk. 2 things are there: general market risk and a specific security risk. They are calculated separately and then add together. Then we talked about the trading book segregation. You can see this word, segregate their trading book. Bank has to keep their trading book. Already we have discussed about this trading book. Bank has to keep their trading book, that is asset they trade, separate from other asset and mark to market them. This means valuing these assets at their current market price to get an accurate understanding of the risk. Now, what was the impact of this amendment? So all these things we have discussed till now was the amendment which was done in 1998, right? What was the impact? So this was a game changer because it allowed bank to use internal model like the value at risk model to determine their market risk capital. This give bank more flexibility but also set a strict standard to ensure they were managing risk properly, right? So this was all about this, and one thing you must remember, that the regime 1988 to 1996 is known as Basel I regime, which recognized both credit risk and market risk. These two risks were recognized at this earlier level. Now let's talk about Basel Committee on Banking Supervision and its power, that is called BCBS power to enforce. Right. So first let's talk about the BCBS. It is a committee that create banking regulation, but here is the thing, right? So it does not have the power to enforce this regulation like a government body. So the first is no legal force. The BCBS does not have any formal supervisory authority, meaning it can't force country to follow its guideline. It can't force country. There is no legal. It has no